They keep talking about the giant crash of 1929. I tell you what, it doesn't even compare to this one coming. So that's why I write and I speak, and I'm very concerned about our futures, our well-being, and the state of the economy.
The only way to get rich will be to buy gold and use debt. You don't pay tax when you use debt. Oh man, do I miss the old Robert Kiyosaki. You know, the Rich Dad, Poor Dad days, like Kevin O'Leary, those old stories of his mother, producing cash flow from appreciating assets. Now the one is just a pump and dumper, and the other one is a doomsday predictor thinking this is going to be worse than the damn Great Depression. But I'm here to say, I think they're all wrong, and I'm going to predict that this is the bottom of the market. Could I be wrong? Probably. Most likely, but if I'm not, I'm going to look like a genius, baby. And let's be real, there's something weird curating on the horizon of the market here. Things just feel different than they did last year when the market was rallying, because obviously interest rates were going up higher and faster than we've ever really seen in the past, geopolitical events. But this time around, it just feels kind of different. I mean, you take a look at the year to date, right? The S&P is up 4% just in this first couple of weeks, which is pretty incredible. And you might recall that I was buying aggressively on the October lows. I took my foot off the pedal during this rally, and then recently in this low, I've been buying super aggressively yet again. And it's all correlating directly to the US dollar, which is kind of hard to wrap my head around. Why is there a one-to-one correlation? Year to date, the US dollar has been dropping as the market's been rallying. You take a look at the 1 year on the US dollar, and at those October lows where the market, hit those crazy bottoms, the US dollar peaked, and it's been coming down ever since. Is this a true sign of a bottom in the market? Like I said, I don't truly know, but look at Amazon up 10.8%, Meta up 6.53%, Royal Bank up 3.5% almost percent here. RioCan, damn it. If you bought RioCan under $20 a share, you'd have almost a 5% yield. You're up 5%. If it just flatlines here, you've made your full year return. Look at Tesla up 14% and Taiwan Semiconductors, this wonderful company I recently just bought here, guys, up 10%. And just taking a look at my individual accounts, it's kind of wild to think that, going back to Q1 to Q2 of 2022, so several months ago is when I loaded up into a lot of these ETFs. And right now my TFSA is only down $1,200. Almost all my ETFs except for the S&P 500, which is now only down 3% in this account. It really looks like I only just bought these recently. You wouldn't think that I bought them so long ago, and that's just the power of cost averaging and buying aggressively when the market dips. Look at my regular account here. I mean, I'm green on VDY in this account. You go on my RSP and I'm up $1,800 on my Schwab US Dividend Equity ETF, and across the spectrum of the whole damn portfolio, I'm only down 1.1% right now, which is just kind of wild to think. I did the math. My iCloud numbers spreadsheet here only updates once every 24 hours, but I did do the calculations from all the individual accounts, and I have crossed $400,000 today, man. What one hell of a milestone. So I thought it'd be fun to point out why I think the stock market is bottom. We're just going to look at some fun little statistics and then listen to CNBC's very own Tom Lee from Fundstrats, who's going to give us an idea of why he thinks the market is going to rally 20%. God knows his past predictions have been horribly wrong, but let's get some hopium going on because I want 2023 to feel better than last year did, damn it. And if you guys want to support the channel, I'm going to be doing new live streams, private live streams every single week on really intense topics around investing, my own personal life and financing, how I make $10,000 a month off social media, how I help my parents into retirement, how my family, my fiance, how we manage our portfolios, and so much more in between. You can support me in doing this project on Patreon, which is going to allow me to do 100% sponsored free content. So these live streams are going to start next week. It's $5 a month, damn it. It is less than the price of a Starbucks coffee. And if you want more in depth, you want to join my chat groups, you want to actually do one-on-one sessions every month, you can sign up for a VIP $49.99 a month. But getting into this, the story no one cares about, inflation. Inflation's dead. I called that several months ago now, literally. When inflation went negative in Canada here, these are the Canadian month-over-month inflation rates. It's all based on a 12-month trailing period. So when you take a look at the US, this is what it looks like. This is the 12-month trailing period. It's dropping month-over-month pretty heavily, but actually the month-over-month data itself that's leading to the trailing 12-month data we see here is right here on the US side, guys. And again, no one cares. It's over. We're done with this. The geopolitical event, no one cares. China's not invading Taiwan. No one cares. Nobody really cares about anything anymore. Same when it comes down to commodity prices. You take a look at this, lumber, wheat, everything that matters that's severely affecting the market, it's all down. It's all crashing. It's all reverted back to a moderate level. Even rent, I'm seeing rent in the areas where I live drop off by a few $100s a month. It just seems like we're coming to the end of the hurricane, or so it feels. I mean, I'm looking out on the horizon. I'm like, hey, it's not looking that bad anymore. It's looking pretty good. So let's see what the good old Tom Lee has to say about this.
Strong omen for the market. See stocks rallying 20% this year. Joining me now right here, Post 9, CNBC contributor Tom Lee of Fundstrat Global Advisors. Happy New Year. It's good to see you. Welcome
Great
back.
To see you, Scott.
So you were admittedly too bullish last year.
Yes.
You are, in a sense, doubling down on that. 20%? How?
Yes. Last year was a year where inflation shocked the markets in the first half. It's come off the boil since October, very soft. I mean, if December comes in the way we think, it's probably 2.6 annualized inflation now. And wages are coming off the boil, right? If we look at the employment report Friday, they're growing at 3.7, which is where they were before the pandemic. So the third thing that we think needs to happen is volatility needs to come down in the VIX. The bond market volatility is below its 200-day. If that happened in the VIX, we'd be at 17.
Yeah, the VIX, something we don't talk about too often, the volatility index representing the trading volume across the market. Take a look at the 1 year, the volatility was just maddening like all year. And now it looks like we've leveled off a little bit, but I want to give you the historical like usual VIX, because ever since the pandemic, the market has never really reverted back to its normal trading volumes that we saw post 2020. So we could still see this level off a little more, which would reside in more confidence in, the market. If we get some continued consistency in the market, it would completely abolish the volatility, because this is probably just mostly trading volume of, traders, shorters, people just taking advantage of it all. But let's continue.
And since 1950, following a negative year, if the VIX is lower on average than the prior year, we're up an average of 22%. So I think we're set up for a 20% year.
Even with the Fed.
It's really funny because you can always find a narrative that fits your ideology when it comes to if you think the market's going up or down. I could show you two different points of data on that we've talked about in the past. Like when it comes to unemployment, if unemployment spikes, that's usually the sign of the bottom of the market. We haven't seen any of that yet. But again, history rhyme, it doesn't repeat. So don't take any of that past data into the future forward looking idea of what the market's going to do.
Even with the Fed speak, if it's not Kashkari, it's Esther George. If it's not Esther George, it's Bostic. Just to make, sure Bostic got his message across. He spoke late last week. He spoke again before the show today. I mean, these guys are talking, and women are talking tough.
Yes, they're talking tough because they want financial conditions to stay tight. That's dollar, stocks, bonds. Everything's kind of easing, so they're probably a little worried, and they want to be sure inflation is, in fact, dead.
That is a super critical point. When it comes to the Federal Reserve, they're never going to give you a bullish narrative on the market, and at least until they're 100% certain what they wanted to achieve has been accomplished. You have to understand they don't want hype. They don't want further inflation like they're mentioning here. So don't take the rhetoric from the Fed as the market's going to keep going down. Like when people talk negatively, sometimes there's literally a narrative behind it. It's not like the actual fact of what's going on. So that could be another sign that, people are starting to wake up to that reality.
I think one of the changes, especially since October, is that inflation's been undershooting. This Thursday will be very telling, but if CPI comes in at 0.2 core, below consensus again, that means the Fed's original projection of 4.8 on the PCE is 60 basis points too high, translating that over. And that means inflation is undershooting by a huge margin. The bond market is going to push the Fed to say February might be the last hike, and then after that is cuts.
So I 100% agree with Tom Lee here. I think the Fed is basing their future forward-looking decisions off the current environment, but that environment has changed dramatically. And you might recall, during the pandemic, they said they would never really raise rates. They had no intention anytime in the near term to raise rates. And what did they do? They surprised us. They raised rates. And you're probably going to see the same thing happen on the inversion here. Nobody actually knows what the Fed's going to do, and laying out a plan today could change if the current macro environment changes. It's just how it works. So again, take everything the Fed says with a grain of salt and imagine that we are going to head into better times. How we get there, I don't know, but that's why I buy the dips, baby. And I'll pass the question off to you. I want to know what you think.